Welcome to the Coin Bureau Weekly Crypto Review and a very happy new year to all of you. Here are this week's top headlines in the crypto news. Suspicious crypto transfers. Wallets associated with Alameda Research start mixing millions of dollars of tokens as Sam Bankman-Fried allegedly cashes out. How could this impact the FTX Alameda situation? FTX Assets Identified. Bahamian authorities claim to have most of the crypto belonging to FTX users, while US authorities begin investigating the supposed exchange hack. When could FTX users be compensated? Support for Solana. Vitalik Buterin voices support for the Ethereum competitor after top Solana projects flee to other smart contract blockchains. What does this mean for Sol? The Dogecoin Merge. Doge takes a dip following rumors that the meme coin will transition from proof of work to proof of stake. Everything you need to know. Ride of the Valkyrie. Grayscale's top competitor offers to take over its famous Bitcoin trust, which continues to trade at a concerning discount. Why this could be a very big deal for the crypto market. And Benjamin Cowen gives us some of his thoughts on where we are right now as 2023 gets underway. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, 30 crypto wallets related to failed trading firm and market maker Alameda Research started to move millions of dollars of cryptocurrency. The transfers were made a few days after FTX and Alameda founder Sam Bankman-Fried was released on bail, leading to lots of speculation. For context, it's believed that Sam was one of the only people who had access to the wallets belonging to FTX and Alameda. Not only that, but Sam has had access to the internet ever since he's been released on bail. Then again, so have the other former executives of FTX and Alameda. In any case, the entity behind the crypto transfers converted roughly $1.4 million of ETH into USDT. 200k USDT was swapped for Bitcoin via RenBTC, and the remaining $1.2 million of USDT was mixed using various services. An additional $300,000 of ETH was mixed as well. For those unfamiliar, mixing services basically break the link between the sender and recipient on a publicly viewable cryptocurrency blockchain. This makes it much harder to track crypto transactions, which is exactly what you want when you're doing something illegal like this unknown Alameda entity. What's interesting is that the entity which moved Alameda's assets split most of them up into 200k batches of USDT. This could simply be because there's a lack of liquidity on mixing services, but it could also be evidence of payments being made to different entities that are involved with FTX and Alameda. If all that wasn't crazy enough, Sam allegedly cashed out almost 700k in crypto shortly afterwards, and the crypto wallet he used is apparently connected to the same Alameda wallets which have recently been mixing assets. Obviously, Sam denied being involved in these mixing activities. However, Sam did not deny cashing out 700k in crypto. Now this is significant because one of his bail conditions is that he cannot spend more than $1,000 per day. That's more than some people make in a month, but hey. If he spends more than 1k per day, his parents and his anonymous bail donor will be on the hook for $250 million. I suppose Sam cashing out 700k technically doesn't count as spending money because otherwise he'd already be behind bars and his parents would already be bankrupt. But I suppose when you're as well connected as Sam's family is, you're able to have a bit of wiggle room when it comes to restrictions. On that note, Sam will be testifying for the first time in a US court in less than 24 hours, and he's expected to plead not guilty to the long list of charges he's facing. You can find out how long he could be in prison for if he loses his case by using the link in the description. Let's hope he finally tells the truth. It's unclear how long it will take for the truth to come to light, however, given all the updates around FTX and Alameda have resulted in more questions than answers. The best example so far is the recent revelation that Bahamian authorities are holding $3.5 billion in FTX customer assets. For reference, Sam & Co. allegedly misused between $8 and $10 billion of FTX user assets. Bahamian authorities having anywhere between a third to almost half of this amount is therefore very good news for FTX creditors because it means we could get our cash and crypto back very soon. The catch is that the Bahamian authorities did not specify which cryptocurrencies they're holding, nor how they're valuing these coins and tokens. The new FTX team subsequently alleged that the Bahamian authorities are basically lying because most of the $3.5 billion they claim to have is in FTX's FTT token. The new FTX team claims that Bahamian authorities only have around $300 million worth of FTX user assets, half of which appears to be in FTT, which of course cannot be liquidated because nobody would buy it. Well, except maybe Kevin O'Leary. In all seriousness, it looks like Bahamian authorities are exaggerating. Now, if you're wondering why, it's because they've been trying to move the bankruptcy process from the US back to the Bahamas. You'll know this if you watched our video about the FTX hearing. You'll also know that former FTX executives transferred this $300 million to those Bahamian authorities. And you'll even know that the $400 million hack of FTX, which occurred shortly after the exchange's bankruptcy, wasn't a hack, at least according to new FTX CEO John Ray. I suppose we're going to find out soon enough, because the Department of Justice is now investigating the supposed FTX hack. Given that the voluntary transfer of FTX assets to the Bahamian authorities looks identical to the supposed hack, it stands to reason that the same person or people were behind both transfers. Again, the only people who had access to these wallets were FTX executives, so it must have been one of them. What's odd is that crypto exchange Kraken earlier claimed to have identified the supposed FTX hacker, yet this story has been completely memory holed. What's even more odd is that whoever supposedly hacked FTX is only facing charges with a maximum of 10 years in prison, according to Bloomberg. This just underscores the fact that it's going to take lots of time to understand what the hell is going on here. The only thing that's certain is that the crypto companies and projects that were most exposed to FTX and Alameda research are going to take the biggest beating. Which leads me, naturally enough, to Solana, which was FTX's de facto exchange chain. Alameda was also one of the largest investors in projects building on Solana. Although some Solana projects, such as Helium, have vowed to stay on the Solana blockchain, others have been migrating elsewhere. If you're subscribed to Coin Bureau Clips, then you probably saw my YouTube short about two of Solana's top NFT projects migrating to Polygon. Polygon offered them grants to build on Ethereum's leading Layer 2, which is an offer they can't refuse given that Solana's ecosystem funding is mostly gone. A few days later, Solana's Sol coin fell out of the top 20 cryptocurrencies by market cap and hit its lowest price in almost 2 years. It didn't help that there was no shortage of headlines pointing out that Sol had fallen by the largest percentage of any large-cap cryptocurrency besides Terra's Luna. Just as the Solana FUD was reaching critical mass, Vitalik Buterin caused a relief rally for Sol with a tweet. Quote, "Some smart people tell me there is an earnest smart contract developer community in Solana, and now that the awful opportunistic money people have been washed out, the chain has a bright future." Vitalik was praised for his positivity, but it's important to point out that this same support could be applied to just about every crypto project out there. Almost every crypto project had opportunistic money people, and most of these people have been washed out as well. The difference between Solana and other struggling crypto projects is that Solana received a significant amount of post-ICO funding, and the team has over 2 years of runway. So long as Solana can survive the bear market, then it's likely it will recover. Whether it can compete again is another question entirely. Now, as I've mentioned many times before, it looks like Ethereum is going to keep the smart contract cryptocurrency crown. This means that so-called Ethereum killers are going to have to find their own niches if they want to continue to compete. I'm confident that Solana will manage to do this. The only caveat is that Solana's close relationship to FTX, Alameda, and SAM means that it's likely to face additional regulatory scrutiny. This is something I discussed at length in my most recent Solana update, and I suggest you watch that if you haven't already. It's still relevant and it's in the description. Now, if you're wondering how much lower Sol could go, it ultimately depends on what the rest of the crypto market will do, and that ultimately depends on macro factors. I personally think we could see another 40 to 50% crash in the coming months, which would mean at least another 40 to 50% drop for Sol. Logically, this means that we will see a similar decline in other large caps too, and some of them are showing even bigger signs of weakness than Solana. Meme coins arguably fall into this category because their value is based almost entirely on speculation, and speculation has almost completely disappeared. This has made their price action especially sensitive to every nugget of negative news, as evidenced by Doge's most recent dip. The meme coin crashed after rumors started circulating that Dogecoin would be transitioning from proof of work to proof of stake. The Shiba Inu dog behind the meme is also poorly, sad to say. The thing is that the Dogecoin roadmap published by the Dogecoin Foundation in December 2021 specifies that a proposal will eventually be tabled for a transition to proof of stake. One of Dogecoin's developers recently clarified that this decision will be made by the community, not the foundation. As such, it seems unlikely that the transition to proof of stake is the actual reason why Doge crashed, but it's more likely than not. That's because the distribution of Doge is heavily concentrated, with the top 10 wallets holding almost 40% of its supply. These entities would basically control the blockchain. Moreover, Doge is merge mined with Litecoin's LTC. With crypto prices going down, energy costs going up, and countries starting to restrict crypto mining operations, a transition to proof of stake for Doge could do serious damage to the bottom line of Litecoin miners and lower the security of its blockchain. This would be bad news for the crypto market because Litecoin has historically functioned as a sort of testnet for Bitcoin. Most of Bitcoin's updates were first done on Litecoin, which is why I suspect that the next Bitcoin update will be privacy-focused. Litecoin recently introduced a privacy sidechain. If I had my tinfoil hat to hand, I'd tell you that powerful entities in the Ethereum community want Dogecoin to become an additional testnet for future Ethereum upgrades, especially those related to governance. Consider that Vitalik is actively advising Dogecoin and has been pushing for the proof-of-stake transition. Also consider that the Ethereum Foundation recently began shutdown of Ropsten, Ethereum's longest-running testnet, because it's expensive to maintain and isn't being used that much. Ethereum developers are also planning on deprecating the Rinkeby testnet later this year for the same reasons. Now, I don't know about you, but having Litecoin as Bitcoin's de facto testnet and Dogecoin as Ethereum's de facto testnet just makes sense. It would also be good for Doge, as it would ensure the survival of Dogecoin, but it could lead to centralization issues for the reasons I mentioned a few moments ago. And seeing as I've already broken out the tinfoil hat, I may as well tell you about another few peculiar crypto headlines related to Valkyrie, an asset manager that specializes in crypto products for institutions. For starters, Tron founder Justin Sun was reportedly Valkyrie's largest client, and by a very wide margin. According to CoinDesk, Justin held almost $600 million of BTC with Valkyrie in August last year. This amounts to a whopping 90% of the assets held by Valkyrie's largest division, Valkyrie Digital Assets LLC. In addition, Justin has previously admitted to being one of the largest shareholders in Valkyrie itself. This is why my eyebrows nearly flew off my face when I saw that Valkyrie had offered to effectively take over Grayscale's Bitcoin Trust, or GBTC. To quickly recap, GBTC is like an ETF, except that the supply of GBTC shares can only be changed occasionally, whereas the supply of ETF shares changes frequently. This results in huge discrepancies between the price of GBTC and the BTC backing those shares. Grayscale holds over $10 billion in BTC. GBTC has been trading at almost half of its fair value relative to this BTC ever since Grayscale's parent company, Digital Currency Group, reported solvency issues. More about that in the description. Naturally, Valkyrie's announcement stating its intentions to take over GBTC specifies that, quote, "In light of recent events involving Grayscale and its family of affiliated companies, it is time for a change." Now, I must stress that this is an unprecedented offer. Valkyrie is only a fraction of the size of Grayscale. And yet, Valkyrie's connections to Justin suggest the company may have the capital required to close this deal, assuming Grayscale is on board, of course. It's highly unlikely that Grayscale will agree, given that DCG makes a lot of money from GBTC, but if things get bad enough, it could in fact happen. Now, this would be good news for the crypto market in the short term, as a Valkyrie acquisition would presumably prevent an additional sell-off in GBTC and the BTC backing those shares. What effects this would have on the crypto market in the long term is less certain, and yet another thing to watch. Fortunately for us, Ben Cowen is also keeping a close eye on what's happening out there, and here he is now to tell us about what he's seeing. Ben, a very happy new year to you, sir, and take it away.
Hey Guy, thanks again for having me. As always, it's a pleasure to be here. Happy New Year to everyone, and now that we have rung in 2023, I thought it might be worthwhile to see just how Bitcoin did in 2022. One popular way to measure the performance of an asset is to look at its year-to-date ROI, or return on investment. And so rather than only measure Bitcoin's performance, say from a major bottom or a major top, we can look to see how it did every year as measured from January 1st. So what I'd like to do is just very quickly look at how Bitcoin fared in the 2022 bear market, measured year to date as a function of time throughout that year, compared to 2014 and 2018. And you'll see that it more or less landed in the middle. Okay, so a pretty standard bear market year for Bitcoin, nothing we haven't really seen before. And so I think that's worthwhile to keep in mind, right? You have 2014, 2018, and 2022. But then it raises the question, right? Well, what happened in the years that came after those major bear market years? And so while we only have two examples, it's still worthwhile to take a look at. We have 2015 and 2019, and of course, we just started 2023. There's two main observations that I'd like to really draw our attention to. The first one is that if you're leaning bullish in 2023, it's still likely worthwhile to temper your expectations, because both in 2015 and in 2019, the ROI over the course of the entire year was somewhere between 1 and 2. What that means is that there's a high likelihood that Bitcoin will not see a new all-time high in 2023. Normally, the year after a major bear market year, Bitcoin tends to go sideways for a lot of that year. Now, 2019 did see a fairly sizable rally. However, most of those gains, or at least a significant amount of those gains, were given back throughout the second half of the year. The other thing that's worthwhile to take a look at is that in 2015, while 2019, the downside was limited from when we started the year, 2015 actually saw about another 40 or 50% correction. So it still is worthwhile, I think, to be somewhat conservative and understand that Bitcoin could push lower in 2023, just if history is any indication, but just to be aware of these two potential outcomes and to say, you know what, it's probably going to be somewhat of a boring year compared to years that we've seen in the past that follow these major bear market years. But those years tend to be really great for crypto because that's where a lot of building happens and what really sets the stage for a future bull market. The other thing I wanted to touch base on is this, season index indicator. And the reason is because we speculated, a few weeks ago that we were heading into Bitcoin season because this was somewhere up here, and that, as we go closer to this green region down here, it means that Bitcoin over at, say, like 90-day ROI is outperforming a majority of the cryptocurrencies in the top 50. And now you can see that we've actually entered in to Bitcoin season. Now, this is somewhat all over the place. We could take a moving average of it, which again will provide a bit of a lag. The last time that we really went into Bitcoin season was about mid-2022. Now remember, what happened in mid-2022 was the dominance of Bitcoin shot up quite a lot. It went all the way above 48% when you include stablecoins. Now, it might raise the question, right? Well, if we're heading into Bitcoin season, and we've been heading that way for a while, why is the dominance of Bitcoin so low, right? Well, one thing to consider is that there's been a sort of a divergence between two metrics. One is the Bitcoin dominance with stablecoins, and then one is the Bitcoin dominance without stablecoins. They used to be the same thing, right? You used to get the same answer no matter what you use, but as crypto has continued to grow, the market caps of a lot of popular stablecoins have grown as well, and therefore they're taking up a larger percentage of the overall cryptocurrency market cap. So while the dominance of Bitcoin, including stablecoins, has been putting in lower lows, although recently it's been putting in higher lows, when you exclude stablecoins, the dominance of Bitcoin has been putting in higher lows really since May of 2021, and it continues to slowly push higher. This is reflected across the board, or at least mostly across the board, when you look at a lot of different altcoins. Now, some altcoins have outperformed Bitcoin, but if you look at, say, yearly candles for a lot of popular cryptocurrencies, ADA Bitcoin, so the valuation of ADA against Bitcoin in 2022 fell about 47 to 48%. Even though ADA fell on its USD pair 92%, it still fell on its Bitcoin pair 47 to 48% because Bitcoin only fell about 64% or so in 2022. So if we were to take, if we were to just go look at exactly how far Bitcoin fell in 2022, you can see it was about 64% or so. Avalanche, AVAX's valuation against Bitcoin fell 72% in 2022. Solana fell 83 to 84% against Bitcoin in 2022. DOT fell 54 to 55% against Bitcoin in 2022. And so on and so forth, right? So a lot of these altcoins fell a lot against Bitcoin in 2022. So then it's like, well, why is the Bitcoin dominance not higher? It's only at 42%. We know part of the reason is because stablecoins now take up a much larger percentage of the market cap. And if you actually look at the dominance of Bitcoin excluding stables, it's already above 48%. And that is really reflected well across a lot of these alt Bitcoin charts, in which you saw these altcoins give back a lot of their gains against Bitcoin that they saw in 2021. A lot of them gave a lot of those back in 2022. So it does look like we are very much headed towards Bitcoin season, where the Bitcoin dominance should continue to break out. Arguably, over a longer time frame, the dominance has been putting in sort of just like a major double bottom, right, on this Bitcoin dominance chart, right? It looks like it's just been putting in some type of major double bottom, poised to break out to the upside. And again, one thing I will remind people is that Bitcoin season doesn't necessarily mean that Bitcoin USD has to go up or down. In fact, in mid-2022, it just meant that Bitcoin was going sideways. And during that sideways period is where the Bitcoin dominance actually went up quite a bit. And so we're sort of seeing all this come together. And I would argue that it's a necessary component for the completion of the market cycle, is to sort of see this dominance of Bitcoin go back up to higher levels. And once it's at those levels, we sort of begin a new market cycle. But again, thanks for having me. Hopefully this has been insightful for the viewers, and I'll look forward to seeing you again next time. Bye.
Thank you, Ben. And that's all for today's Coin Bureau weekly crypto review. So if you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking to maximize your gains during the bear market, the Coin Bureau deals page is where you should go. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I will see you all in next week's episode.